Alright, welcome back to another video. Wow, this past week has been extremely wild. Hope you guys stayed on the right side of it. Hang on tight, there's definitely more volatility to come. But in this video, I wanted to take a look at one of the trades that we had on in the chat room amidst all this frenzy, and that was in Nokia. And we're going to look at how volatility affects complex spreads in general, specifically long verticals, and specifically in Nokia. As you all know, Nokia was one of the popular tickers mentioned recently on Wall Street Bets. Looking at the chart in Nokia, we can see that the range on Wednesday, January 27th, was wild from as low as 487 to as high as 979. With volatility this high, if you got long single calls on Tuesday, you would have banked huge on them on Wednesday, even if Nokia came back down from the skies because there was so much volatility being pumped into the price of the calls. But what if you were holding spreads? What if, in an effort to reduce cost, instead of going long single calls, you went long call verticals on Tuesday? Let's take a look at a vertical spread that experienced what I call price inversion. On Tuesday, January 26th, the 6-7 call verticals for Nokia in the front week were trading for 3-cent debit. Super cheap. One might think pay 3 to make potentially 97, right? Sure, if Nokia expires above 7, that may be the case. However, the next day on Wednesday, when Nokia went from $4 all the way up to $9, because of the huge expansion in volatility all across the chain, this spread didn't expand much. If we fast forward the time to Wednesday 9 a.m., this spread actually contracted to 1 cent, meaning if you bought the call verticals yesterday for 3 cents, you'd actually be losing money even if Nokia went higher in your favor. Volatility was killing the profitability of the spread. But check out what happens in the following hour. If I fast forward the time to 9:07 a.m., check out the value of the vertical now. It's negative 19 cents, meaning you could have bought a long vertical and received a credit and get paid 19 cents to put on this trade. What? Now, the only reason I noticed this was because I happened to be looking at the Nokia options chain and I saw that the 7 calls were worth more than the 6 calls, and I was just thinking, hold up, something must be wrong. And I messaged a chat room saying, hey, check out how the 7 calls are worth more than the 6 calls. And one of our dudes was like, so wait, you can get long the 6-7 call vertical for a credit? That's free money, right? And he actually put on the trade and got filled on 50 verticals, each for a 10-cent credit, and immediately made money when the price corrected 30 minutes later and they went back to trading for a debit. So how does this happen? We know that volatility pumps up the prices of all options across the chain, but how can it pump up a more out-of-the-money call in such a way that ultimately makes the price of a more out-of-the-money call be higher than the price of a more in-the-money call? Because if we look at the chain at the moment in time, the 6 calls were worth about 150, while the 7 calls were worth about 160. If anyone knows for sure what the answer is, please let me know. But my theory is that perhaps a lot of people were short the 7 calls, and because they did not want to risk getting assigned those calls, they scrambled to buy them back. But why did they not want to get assigned those calls? Why were they desperate to get out? And I think the reason is this. Nokia is hard to borrow. When a stock is hard to borrow, if your short call gets assigned, it means you end up shorting the stock. Now, if you don't previously own any stock, your broker is going to have to find shares for you to short. For a stock that is hard to borrow, your broker has to go through the difficulty of locating a party who is willing to let you borrow that stock, and this is an expensive process. Borrow or locate fees can be as expensive as $500 per contract on stocks that are hard to borrow. That's why they highlight that here. So if you had a ton of short calls that may be at risk of getting assigned, let's say you had like 20 short calls and each contract experiences an expensive locate fee, you'd be paying up the ass if you got assigned. Now, of course, no one will want to exercise their long calls if there's so much premium left, but if you were the other party who were naked short those calls, you'd probably be panicking a bit. So I think besides all the halts and volatility that drove options prices up in a ridiculous manner and make them go out of sync, that might be another reason why prices got so elevated in certain calls, and you end up in this situation where a more out-of-the-money call could potentially be worth more than a more in-the-money call. For a brief moment though, prices did correct as high-frequency traders eventually arbitraged this out, but this inversion lingered around for a few minutes, allowing retail traders like us to take advantage of it by buying the 6-7 call vertical and getting paid for it, if they wanted to open themselves up to the risk of being assigned the short call. But in my opinion, the assignment risk is unlikely with all the extrinsic value remaining in these calls. Alright, so a couple takeaways here. First, take a look at the options chain for these volatile meme stocks. You never know what you might find, like price inversion in this case. Second is, understand that if you enter a narrow vertical and volatility gets pumped up hard, you may not make as much money as you would think. I described this in more detail in another video, which I'll link above, but in general, if you're gonna play high flyers, avoid complex spreads. Naked long calls work best because they can capture volatility explosion, and if that's too expensive, I just avoid the trade altogether. If you expect volatility to increase and prices to get wild, it's better to just get long singles rather than verticals or other complex spreads. This way, even if the underlying stock ultimately remains at the same price but goes through an EKG-like pattern throughout the process, you'd still make money from the IV expansion. So that'll do it for this video. Stay focused. There's going to be a lot more volatility coming up. 2021 is just getting started and is way better than 2020 already. Keep an eye out for these anomalies that I just mentioned, and also keep an eye out on the indices. As long as the meme stocks continue to attract attention, I feel that the trend is for these indices to just go sideways to lower. For example, ES, which is just hanging on by a thread at that 50 MA, as well as NQ, which has closed below the 20 MA, which looks to be targeting that 50 MA next. Russell, which has also closed below that 20 MA, and the Dow, which has closed below the 50 MA. There may be some downside plays to be had this coming week in the big name stocks if these indices continue to break and stay below the 50 MA. Obviously, further downside in QQQ would be great, as we're currently in some put butterflies for this coming Friday. But as always, feel free to join us in the Discord if you want to see more stuff like this on a more real-time basis, or if you want to just chat with us and trade with us. Otherwise, trade safe, and I will see you in the next video. Cheers.